The 2020 COVID-19 pandemic has highlighted the crucial need for shares that are resilient and robust, offering minimal volatility and stable long-term returns in light of economic downturns. Belonging to the fast-moving consumable goods sector, with defensive divisions including grains and beverages, a strong balance sheet with low levels of debt, and with a history of iconic and reputable brands such as Jungle Oats, Oros, and Purity, you would think Tiger Brands ticks all the necessary boxes. We, the UCT team, are here today to argue otherwise and issue a sell recommendation with a target price of R140.54 and a downside of 25%. Tiger Brands operates primarily in South Africa and currently has ownership of Coco Cam in Cameroon, one of its only remaining international acquisitions. 52 brands fall under management and can be found in divisions including home, personal, and baby care, beverages, groceries, grains, and snacks and treats.
South Africa's FMCG sector is characterized by restricted pricing power, tight competition, and generally low growth opportunities, and these conditions have been worsened by a weak economy. Combined with structural weaknesses like rolling blackouts and stubbornly high unemployment, COVID-19 has resulted in the largest drop to South Africa's GDP ever recorded, with only a moderate recovery expected. This dampens growth prospects and further increases pricing pressure compared to private labels, with Tiger Brands now, more than ever, unable to pass on ever-rising input costs to consumers. Tiger Brands' consistent underinvestment in CapEx and R&D, coupled with its delayed reaction to the rapid rise of the private label segment, has led to competitors like AVI gaining a structural advantage in this market. The weak operating environment is also non-conducive to increased investment and capital expenditure. Even before the recent economic downturn, Tiger Brands' margins were volatile and, on the whole, declining. Further, we have little confidence in Tiger Brands' corporate governance and current management's ability to dig itself out of this hole anytime soon.
The rise of private labels in the South African FMCG industry is expected to further compress gross margins of branded products, which form the crux of the Tiger Brands portfolio. The low revenue growth displayed in Tiger Brands' consumer brands and home, personal care, and baby divisions is mainly driven by significantly lower volumes due to the growing private labels industry. The Tiger Brands' operating and gross margins have been consistently lower than their peers, with their gross margin going from 37% in 2010 to a decade low of 30% in 2019. This is due to their increasing inability to manage and recover input costs. The COVID-19 pandemic has undoubtedly created a difficult operational environment with constrained consumer demand, thus accelerating the anticipated demise in Tiger Brands' pricing power as they continue to face both new and established competitive pressure. Historically, Tiger Brands' market share of the established brands has been their greatest asset. However, this is now at risk as consumers' perceptions of the quality of private labels relative to traditional brands improve, especially since Tiger Brands has shown quality issues in the past, specifically in 2017, where 1.4 billion rand was lost due to the listeriosis outbreak at one of their meat plants, which indicates poor quality control.
Tiger Brands has a high debt capacity, which gives it the flexibility to capitalize on potential acquisitive growth opportunities. This is, however, contingent on effective management. Tiger Brands' failed African growth strategy, highlighted by the 2.2 billion write-down in 2015 of its acquired Nigerian subsidiary, indicates the possibility of further value destruction going forward due to a lack of proper due diligence and the risk of entering international markets. Whilst there are signs of increased focus on its domestic market and portfolio optimization in the recent divestments, we do not believe management has fully learned the lessons from the past. Thus, the chairperson's statement in 2019 reiterating Tiger Brands' continued commitment to the African growth strategy is alarming. Whilst Tiger Brands' historically stable dividend payout ratio could argue a buy case, its decision made before the COVID-19 pandemic to not pay dividends for 2020 combined with a large and increasingly idle cash holding of around 1.7 billion rand, furthers our concern that management may be more intent on further risky international acquisitions, rather than focusing on the core domestic operations, which are facing significant headwinds with the rise of private labels.
We used the DCF model and applied the perpetuity method in determining the terminal value after an initial forecast period of 10 years. This is because Tiger Brands is a mature company in a defensive industry with stable, predictable cash flows. However, a multi-stage model was adopted to account for the pandemic-induced recession and subsequent recovery. Revenue was forecasted per division and based on both historical averages and key growth drivers. Given management's reputation of squandering growth opportunities, we were conservative in applying spreads to each division's growth rate. We believe each division will undercut historical averages during the recovery period and stabilize during the post-recovery period. In calculating cost of equity, the 5-year average of the South African 10-year government bond yield was used. The growth rate applied in determining terminal value is the IMF's current forecasted inflation rate. Non-operating cash was added back to firm value, representing 6 Rand of our target price. As a sense check, we conducted a relative multiple valuation against industry peers. The valuation further supports our downside verdict. We applied a sensitivity analysis to our base case scenario. Under a blue sky scenario, where cost containment improves and management uses debt capacity to pursue good growth opportunities, we still observe the target price below the current share price. The two-part grey sky scenario, where private labels flourish and our country's recovery period takes longer than forecasted, produces an extreme downside for Tiger Brands.
Our ESG analysis further supports our sell case. The focus on a reduced carbon footprint and the charitable efforts of the Tiger Brand Foundation are commendable. However, the controversial recent appointment of CEO Noel Doyle, who left in 2008 as part of the management team held responsible for a major bread price fixing scandal, coupled with the suboptimal performance of management in pursuing growth opportunities, is a serious cause for concern. As a result, we do not foresee the paradigm shift needed in the culture of Tiger Brands to enact a fundamental change. Also concerning is the company's poor handling of numerous ongoing legal disputes, including the recent ownership dispute over brands in Nigeria and the ongoing litigation regarding the listeriosis outbreak. These result in both reputational damage and unpredictable expenses for shareholders, and highlights the suspect quality control procedures and the risk involved in international acquisitions. We believe legal disputes are likely to continue going forward, thus posing downside risk to investors. We are also concerned that the management remuneration scheme will continue to reward reckless behavior, specifically as remuneration policies and incentives aimed at long-term growth are based off short-term metrics. Although these remuneration policies were previously identified as problematic, the long-serving remuneration committee has done little to encourage management to be more long-term growth focused.
We maintain a negative outlook on Tiger Brands, but are cognizant of the uncertainty of long-term projections, particularly in the current climate. Investment risks to our sell case include increased management focus and performance, which could certainly improve Tiger Brands' prospects, especially if expansions into Africa yield a more positive outcome. However, a tough operating environment is set to remain, with many factors out of Tiger Brands' control, no matter how good management. Tiger Brands' entrance into the lucrative private label segment could surprise us and yield great success and increased market share. However, this is a new and uncharted area for Tiger Brands, and with lots of competition already present, the chances of failure are high for such a late entrance.
In conclusion, a company that once dominated its industry has become distracted and has failed to keep up with the needs of an increasingly competitive market. Strong brands are no longer sufficient to guarantee success, and management has done little to inspire confidence amid many downside risks. In short, to us, this tiger looks far more fragile than fierce. We will now take questions.
Thank you. Judges, please turn on your video. Stay muted unless you are speaking. I will start time as soon as the first judge utters the first word. Time will end at 10 minutes. Feel free to begin.
Thanks for a great presentation. I just wanted to ask, in terms of your forecast, I suppose negative forecast versus company guidance in the market, what's driving the big gap there? And do you not think it's all in the price at this stage? You know, the share price hasn't moved a huge amount in several years. Is it simply all in the price?
Regarding the price specifically, we know that Tiger Brands tracks various South African indices quite closely, like the All Share Index. So in the recent months and about a year or so, we have seen a huge resurgence in equities globally, including South Africa, with similar behaviors occurring in Tiger Brands. So we believe that this is primarily what's driving the recent movements in price. And if anything, it represents an even more compelling sell case.
In terms of other factors that we are very bullish about in our negative outlook would probably be the management of Tiger Brands. We are very bullish on the fact that even the best management, when incentivized incorrectly, is not going to perform up to their potential. Tiger Brands' long-term incentive scheme is largely centered around headline earnings per share, which is a very short-term metric for a long-term incentive scheme. We would prefer to see something like return on invested capital being used, which is the general standard amongst competitors such as AVI. The other thing that we are particularly worried about is the company's use of their cash. They are a very strong cash generating company in a defensive industry with very good quality brands. So our concern is more about what the company is doing with their cash. And historically, that has been pursuing reckless growth opportunities that have destroyed value for shareholders. What makes us even more concerned is the chairperson's statement reiterating their commitment to an African growth strategy, which has proven disastrous in the past. And this is not what we want to see. What we would have preferred to see is the company investing more heavily into CapEx and R&D compared to their peers. They are quite heavily underinvested. And given their sort of destroying of value in the future, we would prefer to see the rest of that cash paid out in dividends.
Thank you so much for the presentation. A quick question. You talked about rising costs and the impact on margins. Can you please show the analysis, like where do you see margins going forward, and just help explain how you derive them?
So we've noticed historically, if you look at Tiger Brands' operating margins and their gross margins, they've performed relatively poor compared to their peers. And this is because Tiger Brands imports a lot of their goods. So there's been the weakening rand, as well as the increase in commodity prices. And Tiger Brands operates in a competitive market, so they are unable to push these prices into the market, and they have to absorb the prices themselves, which has resulted in the loss, which has resulted in their low operating margins. And just looking at the industry outlook and our view on the rise of private labels, as well as the state of the global economy, we don't see this getting any better anytime soon.
In terms of the shareholders structure, what is that like? And have you reviewed the insider trading patterns over the last 10 years? You have mentioned several scandals or incidents. Has there been any incidents relating to insider trading as well?
So a large percentage of, or by a large, around 20% of the shareholding is held by our public investment committee, and the rest are made up of smaller shareholders. I'm not aware of any insider trading in the last 5 or so years, but there may be a colleague of mine that could speak further to that.
No, we don't believe there has been any insider trading. The disputes that we refer to are just kind of negligence on behalf of management, which once again reiterates our kind of pessimistic look on their ability to have strategic insight going forward, which is really needed in the competitive landscape that they are finding themselves in. And yeah, just given the fact, as my colleague said before, that private label market share is increasing. But to answer your question, no, there has been no insider trading that.
I'm not, just to be clear, I'm not talking about illegal or illegitimate insider trading. I'm talking about or asking about fully disclosed sort of trading by executives or insider people.
No, not that we are aware of, in terms of the leaders or CEOs or anything like that.
Okay, and you have mentioned that 20% is owned by the public.
The Public Investment Corporation.
Yeah, and so is the 80% remaining owned by retail clients?
So it's owned by a combination of retail clients and smaller investors.
Okay. Thank you.
So team, you mentioned that they performed relatively okay in the ESG space. So I think you mentioned there was a decrease in emissions over the last few years as well. Have you compared that to the competitors of Tiger Brands and how they have performed in the ESG space as well?
Sorry, can you please just repeat your question? Are you asking if we have
yeah, so you mentioned in your presentation that companies' emissions have decreased over time, right? They've done well to reduce their emissions. Have you looked at how the competitors' ESG performance look like? Are they in a similar place, or are they better or worse compared to Tiger?
I think with regards to the ESG in relation to their competitors, they're pretty similar. All of our competitors in South Africa have done quite well in reducing their carbon emissions and committing to social impact in South Africa. Unfortunately, that does, of course, cut into margins that are already low, given that most of their products are food related, and that South Africa is part of a low income population. So it really does come to investing in marketing and CapEx, where they can make that difference between competitors, but no, relative to ESG wise, they're not too differentiated from their competitors.
And I think with regards to our view of Tiger Brands, their contribution to their ESG is commendable in a way that they've also looked into using recyclable plastic for their bottles and beverages. And they're also looking into using biodegradable materials. And this is all so that they can get their global green footprint. However, with regards to other aspects of their ESG, when looking at their corporate governance and their previous handling in legal disputes, that's where we feel that those aspects further contribute to our sell case.
Is the stock part of the market index in South Africa?
It was part of the all share index until relatively recently, when it was dropped.
Okay.
Can you talk about their market share, and where do you see that market share going forward?
With the growth of private labels in South Africa, we believe that market share is just going to decline. A lot of large major retailers, including ShopRite, Pick n Pay, Woolworths, to name a few, have shown that they have budgeted quite a lot towards their own private labels, which is just going to mean less shelf space for Tiger Brands and also less pricing power. And so we believe only a few of their iconic brands will maintain their market share, such as Jungle Oats and Oros and Purity, as we mentioned in our presentation. But because of the fact that their portfolio of brands is so large, a lot of those will probably fall by the wayside, with private labels coming into play. And having a better perception with consumers going forward.
Given their experience across the market and I suppose their history, do you not think they have an ability to
Thank you, Trina.
No worries.
Thank you, University of Cape Town.